Dear clients, welcome to Phillip Securities Research Weekly Market Update. Markets wait for an ECB announcement, possibly on the 2nd of August. The ECB will probably do another LTRO of sorts, as buying debt on secondary markets will run into balance sheet constraints, or perhaps do both. Other thing is to get the EFSF to buy debt directly on the primary market and not just lend money out after the country has been shut out of capital markets. All are good for buying time, but not game changers in our view. At bottom, debt is growing faster than GDP, and austerity is just feeding that dynamic. Without aligning monetary and fiscal policy, it's very hard to change that in a short amount of time. Thus, imminent backdoor QE by the ECB could induce another short-term rally. The STI could shoot for the downward trend line, Northeast Asia could make another pass at the 200-day moving average, and Europe has already cleared it. But as the underlying vector of the global economy is slower, we would be sellers into this rally, as we remain of the view that the overall equity market trend is still lower. If we recall the lessons of 2009, monetary policy needs fiscal policy to go hand in hand to engineer another bull run. It's hard to see this in fiscal troubled Europe and the US, while China is working through an overhang this time round. Short-term risk on aside, our medium-longer-term portfolio stance is unchanged. We think absolute returns for stocks everywhere till the first quarter of next year could prove difficult, as we favor ASEAN markets, Malaysia, Indonesia, Thailand, Philippines, Singapore, to be relatively more resilient. For the first four, domestic demand and pro-growth government policy counteracts a weak external environment. As for the STI, about 60% of earnings comes from ASEAN and emerging markets. In addition, average dividend yields are 50 to 100 basis points higher than most other indices, which along with the Sing dollar's relative safe haven status makes it an attractive buy in these yield-starved times. Overall, though, we favor fixed income over stocks given our global slowdown, receding inflation outlook. A repressed rate environment is inducing a global search for yield beyond the traditional safe havens of treasuries, bonds, gilts, and Singapore government securities. Portfolios hard-pressed for yield will keep exploring beyond the safe havens, thus we like dollar-denominated EM sovereigns, dollar-denominated Asian sovereigns and corporates, and US corporate debt of the longer-dated variety. Dividend stocks are also likely to be a spillover debt beneficiary. Our Singapore sector strategist is still overweight the high-yielding defensives, aviation services, and REITs. We have issued a formal update report on global macro and asset strategy on the 26th of July. Thank you for watching, and tune in next week to Phillip Securities Research Weekly Market Update.